Hello, good morning everybody, and welcome to Property Masters monthly webinar. Lovely to have so many of you on the line, and if you were with us in June, goodness, a lot has happened in that period of time. I'm sure Angus will take us through some of his thoughts as to what those macro events actually mean for landlords such as ourselves. I'm absolutely delighted today to welcome Ian Hall to our webinar. Ian is Head of Sales North for Landbay, and I was just chatting to him before we went live. He's been in the business for over 20 years, and he's a specialist in more alternative properties such as, well, we'll be finding out today, MUFBs, HMOs, limited company lending, and so on. So those are some of the issues he's going to talk about today and answer your questions. So if you're thinking about moving into any of those areas, then think about any questions you might have for Ian, and you can put them in the chat box or in the ask a question box, and I'll monitor that as we go along. But I don't know if you've heard of Landbay. Obviously we work with them as we work with all lenders, but I thought, Ian, it's lovely to have you on the webinar today. Can you say a little bit more about Landbay and what you do and what's different about Landbay as compared to the other lenders?
Yeah, thank you. Thanks for letting me join you this morning. Nice to meet everyone. My basically my role with Landbay is head of sales, as explained. But the main kind of segment Landbay are in is very similar to the lenders like Paragon, Kent Reliance, and typically they support the landlords that are looking to increase their yield. In fairness, the landlords that are looking to maybe obtain a higher loan amount based on a 5-year fixed rental, maybe HMOs and multi-units, which we're going to discuss very shortly. And things like limited company lending, where accountants suggested clients move into structures that were not commonly used before 2006, and obviously now, Buy-to-Let's only been around for 26 years, but limited company is becoming more and more aggressive in our market, and that's the kind of space we're in. So we're not like BM Solutions, or we're not like Godiva. We do cater for the landlord that maybe is a higher taxpayer or has got a lot of property. And as I say, the landlords that are looking for that extra yield. Because typically BM Solutions and Godiva don't get involved with the size of HMO we're happy to deal with, etc.
Fantastic, that's great. I just wonder if you're a little bit touching a mic or something, Ian. Sometimes I couldn't quite hear what you were saying. I'm not quite sure if that was what it was, but anyway. Fantastic. That's a great overview. Thank you for that. And we've been talking about the trend among landlords to do just that. Look at other ways of boosting rental yield. So any questions on those sort of issues for Ian? It's a great opportunity to actually talk to a lender about what they're looking for, and any advice about how to go about getting that kind of a mortgage and move into that kind of investment. So Angus, you want to just, as you always do, sort of give us a bit of an overview on what's happening at the moment. As I was saying, a lot's happened since we were together in June.
And hasn't it, Christine? Yeah. Just one thing before we move on to sort of the news. I mean, we talked last month. We were talking about HMOs and planning legislation for HMOs. I mean, this is the opportunity for any of our viewers to talk to Ian about the other side of the fence from planning. It's what do lenders want in an HMO? What don't they like in an HMO and the multi-unit block and so on? So please engage. Please ask the difficult questions of Ian while we have him here, because he's the specialist and he knows all about it. So as you said, Christine, they say a week is a long time in politics, and my God, it has been. We've had a month since we last saw you guys, and we have lost the Prime Minister, who was run out of parties to go to by the sound of it, and his party has decided that they've had enough of him. So we're going through an election process for a new Conservative leader. We will have a new Prime Minister on the 5th of September, and who knows what that's going to bring. So a degree of turmoil in this summer period. So what's it going to mean? Well, the government was moving forward with the Renters Reform Bill. It was in the last Queen's speech. Well, that's sort of been stopped in its tracks, hasn't it? So I can't see us getting any further movement on it until there's a further Queen's speech, which is presumably going to be Octoberish time, and then we may get some clarity as to where the level of priority is. And again, we're going to have new ministers going in to do new roles, all shaking up, and really depending on which of our two candidates become Prime Minister, we could have quite an interesting time. That said, I do think that we are going to end up with some reform of Section 21 at some point, and so I wouldn't ignore that in your planning in terms of what you're going to do. So net zero. I mean, if you've been listening to some of the debates over the last few week or so, I mean, climate change is going to be one of the challenges that we all face. We know that. We've had a heat wave this week. My God, it was hot at the beginning of the week. Yeah, I think we can all see climate change is here. How are we going to do something about it? And we're seeing some of these candidates perhaps a little concerned about the costs of doing net zero at a time when we all understand that we need to do something about it. So I'm not certain exactly what the process is going to be, but we are going to see, we're going to have to see some changes here. EPC changes I can see are going to continue. What the level of priority, how it's all going to work is all in the melting pot, and we'll see where we're going. Well, this morning you'll have heard that the Eurozone has gone from negative interest rates to positive interest rates with an initial change of 0.5%, and we're going to see further changes there. We had the Governor of the Bank of England a day or so ago saying, or certainly hinting strongly that the beginning of next month we're going to get another 0.5% rise in interest rates. I think I was surprised it wasn't 0.5% last time, and I think we can all see that it's continuing to move up. And this volatility in the market is challenging for us as brokers, for lenders, and also for you as landlords. Products come, products go, very, very quickly. And we're seeing significant increases by lenders. I know there is a major lender closing all their rates later today, and be repricing presumably Monday. And we're going to see a lot more of that, and the volatility, the speed that you need to move at as a landlord is key. We get a lot of disappointed people who will come along and say, well, I want product X because the rate's good, but it takes them days to come back to us. It takes them days to get the right documentation sorted. By the time they do, the product's gone. There's not a lot we can do about it. So to lock in stuff, you need to move, and as landlords, it's really important. There are good deals still to be had out there, but you do need to be ready to move. So we've had 5 base rate rises in a row. We're going to get another one, and that's key. And the costs are substantially increasing, and I think that's going to put a lot of pressure on a lot of landlords. The fact that you can't offset in most cases in the way you used to the interest costs is going to start to hurt. That's one of the reasons why limited company is of interest, and one of the things I'm sure Ian will pick up on the benefits of limited company as opposed to owning properties yourselves. And we see a lot of people moving into limited companies when they're acquiring new properties, and I think for many people they need to have a strategy now of how they're going to move their properties forward. Do they want to move them into limited company? Are there issues with capital gains tax? Get yourself some tax advice. Absolutely key. Understand, have a strategy. Don't just sit there and wonder. If you've got a significant portfolio, you need to do something. You need to think about it. So, as I said, lenders moving their products around rapidly. And I think the other thing we need to talk about here is criteria. We're seeing quite a lot of criteria changes in the market at the moment as lenders move their criteria and move their pricing. We've seen lenders who are shifting criteria and pricing because they can't cope with volumes. And I think one of the challenges for many lenders in this market is they suddenly, if they've got a product that is suddenly looking very good in terms of price compared with everybody else, they're getting inundated. They can't cope. Service levels are out the window. They then reprice or they change their criteria to try and stop the problem. And that's proving very interesting in the market at the moment. So, but my advice to landlords is look at your portfolio, understand what you need to do, talk to us for some advice and guidance, move quickly if you want to get the better rate. They are only going one way at the moment, and please talk to us, and we'll do our utmost to help you.
Mm.
But over to you and Ian, after what has been a volatile few days, couple of weeks in the political market and with interest rates.
Yeah, absolutely. But I mean, it's following a trend, isn't it, really? Because there has been a steady squeeze on landlord costs in terms of, as you say, no longer being able to offset mortgage interest, increased cost of regulation. But it's been kind of manageable because interest rates have been so low. That's given landlords the headroom, hasn't it, Angus? And that's what's now changing.
Yeah, and I think for some people, it's going to mean they're not profitable on their properties.
Yeah.
They need to give some thought, and they need to have a strategy. And it's as rates continue to go up, there's substantial shifts. I mean, we're seeing before we get this next increase for a typical mortgage, interest-only mortgage, we've seen an increase of £174 per month at the beginning of the year. Well, that's a big shift on a standard property. Now, we've had such low rates for so long, people haven't understood the impact of what's going to happen with increased rates, and they've been cushioned. And you've got the other added challenge that you've got rent having to be pushed up in some cases because the landlord needs to push it up, increased competition for those properties at a time when inflation is an all-time high, or maybe not an all-time high, but inflation is substantial at 10% or so. People struggling with the costs of fuel, petrol and electricity. We're going to see a squeeze, and we're going to see tenants there who are going to struggle to pay the rent. They're not going to be finding it easy to cope with an increased rent at a time of everything else going up. And I have a horrible feeling we may see some pain in this market. I mean, the only thing that is maybe a bit of a saving grace is that it appears that the rapid increase in price of properties may have topped out. And again, it'd be interesting to see Ian's views on that and what they're saying. I mean, all I would say is we are seeing huge numbers of appeals on valuation where the lender surveyor has come in at a lower valuation than the customer was expecting. Now, I don't know whether that's instructions going out from lenders to say, surveyors, please be really careful here. We're seeing potential downturn and we're a bit worried. But I know that I've got a number of appeals running currently where the customer thinks the property is worth X and the lender is saying, or the lender surveyor is saying it's worth less than X. And that's, again, preventing people getting the mortgage they want. So very hard. Always.
Yeah, Ian, I'd be interested in your perspective on that one. I know we've wandered off what we were going to talk about. We will get back to specialist lending, but on down valuations, what's your view?
Well, can you hear me better now? Is that better?
Yeah.
Super. So 2 points. I'll pick up the point on the interest rates because Angus asked, do we think we've seen the top of the interest rates? I'm not sure. Yes, a lot of lenders have kind of increased their rates to protect service because there's a lot of lenders that have kind of been pushed out of the market because of pricing. So therefore, the squeeze has become more kind of concentrate on those that left in. And we were left in, and our squeeze has been quite significant. So we have increased rates to protect service to a degree. However, the swap rates have increased substantially over the last few months. They have started to settle, which is good news, because swap rates typically predict where the Bank of England base rate is going to go. There is I agree with Angus. We are going to get an increase on the next review from the Bank of England. Probably whether it's 25 basis points or 50, time will tell. But then after that, I think there's going to be a period of settlement because obviously we're going to expect a new Prime Minister in September. And obviously, depending on their strategy, will depend on where the Bank of England base rate is going to go, whether we're going to go taxation or whether we're going to actually go kind of cutting taxation. In regard to valuations, in fairness, we aren't seeing too many down valuations, like a peak in down valuation. So it's interesting to hear. I think that a lot of people do get concerned about the lenders giving suggestions to valuers to be careful and be cautious with valuations. But I can promise you, for all the lenders I've worked for, we have never done that. And I'd be very surprised because the relationship between a lender and a valuer has got to be pretty kind of transparent and kind of separated. But from valuer's point of view, I can probably understand why they are being very cautious because there has been a heat to the market, which has meant that people are paying over the asking price. And I think valuers are very concerned with that. because they don't know where the market's going to move in the next 3 to 4 months. I think hopefully we won't see a downturn in property prices because there's still the undersupply in the market. There's still a very kind of healthy private rental sector that's continuing to kind of keep pace. Some interesting stats we do from presentations and landlord feedback is that landlords are maybe changing the way they buy, which might mean there's a steer away from city centres. I'm not suggesting city centres aren't very good properties to buy rental properties still, but landlords are moving to the conurbations where maybe the rent is a little bit higher, the valuations are a little bit cheaper. So a lot of properties up north are doing very well. So the northeast is currently the best yield for properties in the country. There's a stat that we also found. I think this was actually Hamptons found this. That typically the average distance was maybe 30-40 miles from a landlord's residential property where they would buy their buy-to-let. That now the average distance has gone up to 160 miles. So it just shows that the landlord's appetite is actually growing to find the properties that give them a balanced portfolio. So yes, you might chase yield, but also balance it with capital growth as well. So that balance there has become kind of very, very integral to a portfolio landlord building property.
That's really interesting. Again, that search for yield is what we wanted to talk about today in terms of, less familiar investments like, the MUFBs and HMOs and so on. I mean, let's start with MUFBs. I mean, what is an MUFB and why would a landlord consider it as part of their portfolio?
So there's many different things. Can I jump to lead that, or is Angus? Can I?
No, over to you. You're the specialist here. Yeah. I'm just here to learn.
So an MUFB for us is what's called a multi-unit freehold block. Some lenders call it a multi-unit block. So what we have in the middle is the freehold. So typically what you have is a landlord that typically bought a house that's too large to be a single dwelling. So what the landlord's done is split them into flats because the yield increases. So if you typically rented that single terraced house out to one family, you may get £1,000. But actually, if you split that into 3 flats, you probably get £750 per flat. Therefore, the rental yield is nearly doubled. More than doubled, sorry, £2,250. So that can happen on a small scale where it's a small terraced house converted to 2. But there's certain areas where we all know that you've got large single dwellings that used to be family houses that have been converted into significant size flats, 10, 11 potentially in a flat. So the yield investment there is substantial. You can also have a situation where maybe a landlord has bought a piece of land, built 2-3 houses on that piece of land, and not looked at splitting the title. That would still be a multi-unit freehold block to us. There are a few multi-unit leasehold blocks in the market. Some lenders do them. We don't do them because there's a freehold and leasehold kind of ownership issue. But there are still there are lenders in the market that still would offer a multi-unit leasehold, but be very careful that there's only 2 or 3 that will offer leasehold multi-units rather than kind of freehold multi-units. Typically, when you are looking at a multi-unit, the things that a landlord's got to take into account is the size of the units. Are they bed sits? Are they full-on flats? Are they self-contained? So they're going to look at the size of the individual units. Are they 25 square meters, 30 square meters? We're 25 square meters per unit. Some lenders are 30 square meters per unit.
So you mean that's the minimum size you're willing to accept, 25 square meters, yeah?
Of each unit, yes, exactly, yeah. So again, bed sits are different. Bed sits kind of are a hybrid between HMO property and multi-unit. Multi-unit, the lenders typically want them to be self-contained. So that means that, as I say, they're larger than 25 square meters or 30 in some lenders' circumstance. But also the utilities are split. So each individual flat might have their own gas and electric supply. That's very relevant when it comes to a multi-unit as well.
Right, there's a lot to think about there. And these are the things that lenders look for. They will be asking you all these, size, utilities, and so on.
Correct. I mean, you've got it's yield. So the yield, as I say, is double the yield of a normal standard rental property. So landlords shouldn't be kind of avoiding them from their portfolio plans. They're good. I mean, I like them because not all your eggs in one basket. If your tenant moves out of a single dwelling, you lose all your rent. If one tenant moves out of a block of flats, actually you only lose 1/5 maybe of your rent because you've got 5 flats. So actually, from an investment point of view, it's a very good opportunity still for many landlords.
Yeah. Angus, what about, obviously you deal with a number of lenders with, MUFBs. I mean, what are the common issues you would point out to clients if, they're on the line today and thinking about it?
Well, I think the first thing that Ian's mentioned, size of each flat. Don't have flats that are too small. If you go, there is almost nobody in the market that will do anything less than 25 square meters. And we occasionally will find somebody who's converted a block and they've got, 3 which are of sufficient size and the 4th one stuck in the loft and it's not big enough. And that becomes a real problem. So when you're doing a conversion, when you're doing your planning, make sure that each one is at least 25 square meters. Otherwise, I can see challenges downstream. The other thing to recognise is that these are not for beginners, and many lenders will not consider you for a multi-unit block if you haven't got some existing buy-to-let experience. The same with HMOs. So don't assume that you can walk straight into this more complex area without having had a little bit of training, a little bit of experience in being a standard buy-to-let landlord before you. So they like you to walk before you run, and I think I can understand that because it's a much more complex area to work in. So Ian, I don't know about Landbay. Do you require people to have prior experience?
Yeah, it's just put in the chat box there. Ian, over to you.
Yeah, we require 12 months experience. Is my signal okay? Yeah,
you can see that. Yeah,
we're breaking up a bit there. But...
Okay, we require 12 months experience, but a lot of lenders in the market require more. So we're probably on the less cautious side. Some of the other lenders like Paragon, etc., are 3 years in experience, and our rate are similar to Paragon. So their kind of tolerance is a little bit higher. The other point to make as well, with Angus making the point about the 25 square meters, I think the landlord's got to have a plan as well. Are they buying a multi-unit to always keep as a multi-unit, or would they have plans to split the title in the future? Because if they are looking at, for example, you buy a block of flats and the value of the block of flats maybe there's 10 flats in the block and it's worth £1 million. They buy it at £1 million, but actually if they sell the flats individually, the flats are probably worth £150,000 individually. Actually, a landlord's strategy might be to start selling those flats individually in the future. If that's the case, then the square meterage is more important. It would have to be 30 square meters. So that's just for their plans in the future, depending on how big the multi-unit is, whether there is a market for individual dwellings to split the title.
So that might be your longer term strategy to sell off the individual flats. So what you're saying is if that is first of all, think about a long-term strategy. If you do, and that is what you want to do, then you should be thinking more about 30 square meters than 25.
Yeah.
That's really interesting. And what about the price? Sorry, Angus.
I'm sorry, I was going to say it is not unusual for somebody to be doing a conversion, doing some property development, and then maybe they've got four flats in there, and their immediate strategy is to sell off 2 of them, keep 2 as part of their portfolio, and use the revenue from selling those 2 to go and do something else. So we see that all the time. So I think Ian's guidance there on making sure the sizes are sufficient is absolutely key, and it's the simple things that people don't think about. When they say, well, I've got this property, I can convert it, blah blah blah, without understanding that there could be challenges downstream if they do things too small. And I've said a few times.
Alex, what about the pricing for this type of lending? I mean, how does it compare to more standard buy-to-let mortgages?
Well, generally it's priced at a premium to the standard buy-to-let. I'm sure Ian can tell us a bit more about the reasoning why there is a premium there, but I can see there's a slightly higher level of risk in some ways for the lender. But if you're doing stuff through a limited company, probably the marginal difference isn't as great as it would be from a standard buy-to-let going up to an HMO or a multi-unit block. I mean, Ian, have you got any comments on the pricing strategy which lenders use?
The yield, the difference in pricing used to be quite significant. It's now a lot smaller. There's lots of lenders that are pricing single dwellings the same price as HMOs and multi-units actually. So that differential has become a lot smaller. Although once you get to the larger scale HMO or multi-unit, which is typically 7 and above, the price does jump up quite a bit. So the smaller ones, the price difference is not huge. the larger ones, there is a big price difference because that's the interpretation of maybe the property being a little bit more commercial rather than kind of residential.
And do you think that's a result of competition in the market? I mean, a few years ago, there were many fewer lenders willing to consider some of these properties, and a lot of people have come into that over the last couple of years, which presumably has helped with. And as you rightly say, the larger ones, there are few players willing to consider 7-bedroom, 7-room, 7 flats and above, or 7 bedrooms and above in an HMO. And it's
definitely is competition, but I think it's also, and this is very common probably with HMOs more so than multi-units, but the condition of the properties, because we used to get MUFBs that were the lower end of the rental market. Now, if you look at a multi-unit freehold block or an HMO, the quality of the conversion, the quality of the services on offer for that tenant are just huge. And actually, lenders are looking at that and saying, actually, that's a great asset for a lender because the tenants enjoy living there more than they ever have.
Yeah, that's interesting. The quality's improved. I mean, what about the comparison between, say, HMOs and MUFBs? If you were, looking at these issues of where should you go? I mean, how would you differentiate HMOs from MUFBs, and what are the advantages and disadvantages of them? We talked a lot about HMOs last time with planning permission because there's so much going on in that market. So, Ian, what about HMOs? Is it still worth considering?
100%. I think we could spend a day talking about the difference between HMOs and multi-units and the advantages of both. But essentially, they're very similar in nature. They're very similar in yield. I'd probably say, on a personal experience, because I've dealt with repossessions from a lender back many years ago, where we actually managed the properties out. HMOs are probably a little bit more difficult to manage, because you've got to get the harmony with the block perfect, because if you have one tenant, because they all live together, they share a kitchen and a bathroom, it's a lot harder to get the harmony right with an HMO compared to a multi-unit. But that's my personal opinion. Student let is probably a little bit easier, but student lets are pretty hard to find now. I think from my point of view, a little word of caution as well for landlords is be careful where the location of the student let is, because there's a lot of universities that are very established that have certain areas where the students want to live, and pushing that boundary a little bit further and maybe buying a property and converting it to an HMO, you've got to make sure you do your research to make sure that will still attract the same yields as the properties might do in a closer area to the university. Just be very careful and do your research in regard to where works and where doesn't work.
One thing to add to that, Ian, which came out of our planning webinar last month, many cities now have introduced Article 4 areas where you need to get planning permission for a new HMO in that nice area which is near the university, which the students want. And many councils are refusing that. So unless you've got a property that's got grandfather rights, you could find a property you think it's going to make a great HMO, currently a terraced house or whatever, and you'll be refused planning permission. You won't be able to get a mortgage, and the challenge exists. So, so you're absolutely right. Look at the area, make sure it's one that's got student demand or tenant demand there, but also check out the planning rules, and don't forget the licensing rules as well. But in particular, planning rules, are you going to be able to make it an HMO in that location?
And that's sort of right. Sorry, Ian.
Sorry. On Angus's point, I would also say, yes, look at the rules now, but also maybe put a phone call into the council, because lots of council have put blanket licenses recently. Birmingham, for example, is one of the councils that have slapped a license on a significant portion of the city. And obviously what landlords may have done is bought the property, done a bit of refurb, and before they start renting the property out, if that council has put that license in place, then you then can't let that property as a multi-unit or a HMO, sorry. So you've got to be on the ball with the council, as well as not just looking at the rules now, make that proactive call to see whether there's any change or plans to change.
Well, and the good news is they have to give 12 months notice of that change. So,
but they don't kind of market that change very
No, that's what I was going to say.
Yeah. They don't. Of course, they don't market it.
No.
If you make that call to the council and they say a change is coming in next April, as long as you've got it as an HMO before next April, you have grandfather rights for that property in perpetuity. whilst it stays an HMO. So, and that increases the value of it. So, understanding planning and understanding the constraints that are going to get imposed, absolutely key. And as you say, Birmingham and Nottingham and some other places have done huge swathes of the city where they've got some of these constraints, and they're slowly extending them. So you need to be on top of that as a landlord, and it makes it difficult.
And there are similar moves in holiday lets as well. I mean, we had a webinar a little while ago on holiday lets, didn't we, Angus? And there's a lot of movement there with licensing as well. Yeah. Well, is it a question here, Ian, from Ken? What are the pros and cons of, we were just going to come on to limited companies. Thank you, Ken. What are the pros and cons of setting up a limited property company to start my buy-to-let portfolio? Ian, we are seeing so many landlords now going into limited companies to buy property and even thinking about whether they should move their existing portfolios. But I know that's not as simple as it sounds. But to answer Ken's question, what are the pros and cons?
I should have done accounting at university rather than economics. I think the first thing to say is that you've got to make sure that, and I say this in all presentations, you've got to make sure you speak to an accountant. But when I say accountant, I actually mean a proper accountant that actually specialises in property and taxation. Gone are the days where, in my opinion, a landlord should be relying on a bookkeeper doing their tax returns. The landlords have definitely got to get the right advice, and unfortunately that might cost a little bit more than a bookkeeper may have cost, but I really do think you will get the benefit and make sure that obviously your portfolio is going to be fit for future. I think there's lots of pros and cons, obviously not advice, but if you live off your rental income, then really as a limited company maybe the future for you, because obviously if you put your assets in a limited company, you're paying corporation tax, but then you're also paying tax to bring the actual income out of the limited company. If you don't need the income, then it's a different kind of kettle of fish. The income growing in a limited company is very, very attractive because it becomes very beneficial with regard to planning, IHT planning. It's very good with bringing people that are not necessarily on the mortgage into the limited company to actually share the profit in the limited company. So it's a very good planning tool.
Oh, sorry, I thought we'd lost you there. Yeah.
Yeah, just to add to that, I mean, Ken, if you're thinking about it, buying your first property, as Ian says, go and talk to tax specialist, accountant who understands what the space is. In most cases, there are some real benefits of putting it into the limited company. If it's your first and understanding of building a portfolio, this is not tax advice. Go and talk to somebody because your situation may be different. But and especially if you've got sons and daughters you want to involve, you can actually change the shareholding over time and pass the asset down. And as Ian says, from an inheritance tax perspective, there are some real benefits. And you can offset some of the interest costs, which we're talking about at the moment, because that corporation tax, well, depending on what happens with which prime minister, is either going to go up or go down. I mean, my crystal ball is no better than yours, but yeah, I do think that there are some significant benefits in many cases to going down the limited company structure if you're buying a new property. At some stage, HMRC may catch up and start taxing property companies in a different way, but I think it's difficult for them to impose rules on different types of elements. I think the other thing, make sure that any property and company you set up has got the right classification codes. There are only about 3 classification codes that most lenders are willing to accept. So don't assume you can use a trading company to buy the property. Generally they need to be specific property related companies with specific SIC codes to go through.
That's an interesting one. Yeah, I mean, Ian, would you agree with that you have to get that classification? It has to be a new company that is set up specifically for this purpose, and it has to have a specific code. Is that correct?
I would agree, although we do trading companies. However, housekeeping wise, obviously you kind of from a broker's perspective, it means you've got less lenders of choice, which is obviously therefore not going to be as competitive. The difference between our rates is only 10 basis points, so it's not a significant increase in value or cost for a trading company. However, if you're approaching a broker would always want your limited company in an SPV, specific purpose vehicle. special purpose vehicle. Yeah, I agree with Angus. It's worth making sure that you have got.
Yeah, I mean, we've got 2 or 3 lenders who will consider a trading company, other than, but you're down to a much smaller market, and therefore you're less likely to get the better rates.
Yeah.
And if you're setting something up new, and you don't have, if you've already got a trading company with a lot of value in it, and you want to do something, then that's a different kettle of fish from setting something up new and starting to move into property. And I think again, it comes back to get some advice from an accountant who understands your personal situation, understands what you've got, and understands where you need to go.
On that point, I completely agree. I think I've seen the landscape change of limited company, and I say go and see your accountant, because your accountant may suggest things like layered limited companies, which obviously then take the advantage of a holding company and a subsidiary. A lot of lenders will lend to that kind of circumstance, which is very similar to having a trading company and an SPV for your property, and they're all linked.
Yeah, Ken, well, hopefully that's given you a little bit of insight. I mean, please do come back, because there's a lot of information there. If there's anything specific you want to ask Ian or Angus on that issue, if you are starting out, and obviously come and talk to us. Angus, I'm sure you'd love to talk to Ken if he's thinking of starting his investment journey. So, Ken, any other questions, let us know. And indeed, anyone who has any questions, pop them in the chat box or in Ask a Question, and we'll deal with them. Tusha, hello, hi. Tusha's on the line for Angus. Completely different question. Are you planning to do a similar webinar on extending your lease, pros and cons, and ways to go about it? Well, we were talking about leases, weren't we, Angus? And yes, maybe we should do something on that.
I mean, we haven't got any specific plans, Tusha, but I mean, happy to talk briefly now about it. Every lender will have a limit to the amount of time left on the lease when the mortgage is due to expire. And if you start getting down to that, you will find that limit. You will find that there are very few people in the market who are willing to work with you. So there are significant benefits in having a longer lease if it's a flat and leasehold property. So so Ian's putting in 60 years left on the lease. I mean, there are some at 50, there are some slightly higher if I remember rightly, but every lender is slightly different in terms of their requirements here. And as a result, if you know that your property is leasehold, if you know that there are reductions there, then it's worth trying to extend it. Now, clearly there are some costs involved, and if you're a tenant and you've lived in that property, or if you own a leasehold property and you've been there for 2 years, you actually have some specific rights in terms of marriage value and everything else. Slightly different rules apply if you are an owner and you're renting it out, because my understanding is it only is if you're residential that you actually have all those rights. But again, you might want to talk to a specific property lawyer about what your rights are in those situations. And as we've seen property values increase, the marriage value, the cost of extending that lease will have increased. But as you get nearer, that 60 years or whatever, that cost can increase substantially. So sometimes the earlier you can do it, if you can move it onto a 999-year lease or something like that, the earlier you can do it, the better. I mean, I know I used to manage a 140 leasehold mansion flats in London. I was the chairman of the freehold company, and the costs of doing some of this stuff was frightening. What I would say is that many lenders will understand and will increase a mortgage to facilitate you doing it. And so, as long as they see the value, they understand that a longer lease has value, and will be in many cases willing to help in terms of that. But get some guidance, talk to a specialist property lawyer, understand some of the valuations, understand the process, and in many cases it's worth your while considering, and the sooner you do it, the better.
And Tisha's asking, Angus, do we know, could we suggest a firm who specialise in this? I'm not sure if we could, but or how could Tisha find someone who could help him?
I haven't got any off the top of my head, Tisha, who I would feel comfortable recommending. Ian, I don't know if you know any specific firms that you would be willing to recommend. Probably not. I mean,
no, it is a specialist field. I think you've got to be careful if you are extending the lease and you're using a lender to extract the funds to be able to extend the lease, definitely use the same solicitor. Don't use a different solicitor to extend the lease and then want to do the conveyancing on the mortgage. That's the only tip I can give.
Okay.
Interesting stuff. Any more questions, please do pop them out. Tisha said, I've had various costs and it's a bit confusing. Tisha, are those costs to extend the lease or to advise you? Or because I mean, how is it? Is there a standard way, Angus, that it's calculated how much it's going to cost to extend the lease? How can you judge?
The answer is there is a basic calculation. I think a lot depends on the freeholder and how they wish to impose the rules. And I think there's probably degrees of interpretation there in terms of how they do stuff. I'm no specialist. I know I've been in a situation where I've been that freeholder, and we took quite a we liked our tenants, the leaseholders with it, who all own these £1 million flats or whatever. And so we took quite a sensible approach and a pragmatic approach. So we weren't trying to take advantage of them. But I think there probably are some freeholders out there who see it as an opportunity to raise significant sums and perhaps might not be so beneficial. Yeah, I mean, Tusha, by all means, drop me an email. I'm not going to give you advice, but I'm happy to have a look and see if I can talk to anybody I know and point you towards somebody, if that'd be helpful.
Yeah.
So,
and would that be, Angus, is the property-master info at property-master.com. In fact, if any of you want to drop us a line on any of the issues today, or generally, want to make contact with us, so it's info at property-master.com. We're always happy to hear from you and try to help.
And it may be, Christine, I'm thinking, could we find an expert to come and sit on this to help us, and we can use Tusha as one of our examples. There's clearly a demand out there.
Yeah.
Let's
actually, that would include me. I've got a flat with a lease, so I'm getting a bit. I'm with you, Tusha. I would like to know more as well. So that's.
I do think people forget. They start off with these 1 to 5 year leases, and on the property, and the property is 50 years old, and it's starting to cause a bit of grief now.
Yeah.
And what do you do? So.
I think it'd be an excellent. I think that'd be an excellent shout as well. Obviously, not me for a start, but I think we're seeing a lot of people creating new leases. Again, similar to the scenario where you've got a multi-unit block and you want to create a brand new lease, it can be a very kind of complex kind of scenario doing just that, and it can be very costly as well.
Interesting.
Yeah, I think we could do something on lease. I mean, there are houses out there which one would normally expect to be freehold, and there were a whole pile of builders who made them leasehold. And I know they've been harassed and harangued in the press, and supposedly for many of those builders, they are letting them transfer to a freehold status. But again, it may be that some of our landlords have got properties which are in that situation. So I think leases as a whole is probably an interesting area to explore. Which lease extensions is bar one. But as you say, if you're setting up a multi-unit block, you might want to have individual leases within. Well, in some situations, if you're doing what we talked about earlier, where you're converting a property, putting 4 flats together, you will want to have, and you're selling off 2 of them, you'll sell them off with leases, because that's the only way to make it work.
Yeah, absolutely. What about property development? I mean, we've been talking to our planning guy, and there's a lot going on in terms of permitted development, like in town centres, for example, and high streets where retail outlets are no longer needed, or in offices, well, we're working from home much more, and so on. And do you think are you seeing clients looking to develop properties perhaps from what were high street shops and commercial properties? And what would your advice be? I know it's a big area, but any sort of pointers from yourself about whether that's a good idea?
Yeah, we see a lot of permitted development, mainly in the kind of city centres where they're kind of re-establishing a previous commercial that's maybe below a normal residential flat. We do a lot of that, and a lot of them are done very well. Valuers don't always like them though. The ones that we do find difficult are the conversions from office blocks to residential, where the office block they've done a good job, but it still doesn't look pretty. And again, because of the saturation in certain areas with regard to residential flats, you've got to be careful. I would probably be a little bit more wary when you're buying a conversion from office to residential in a big block in city centres. But small ones, then yeah, we're doing an awful lot of those.
Yeah. Angus, I know you've talked to the Daily Mail once about, a little while back, about permitted development and some of the issues that Ian is saying there with offices into homes.
Absolutely. I think one of the other things that if you were looking at a conversion from office to a flat is soundproofing. The office was not designed to be soundproof between different flats, and trying to retrofit that sufficiently is challenging. You may have concrete floors or other things which aren't necessarily soundproofed as you might want, and certainly we've heard issues with that type of scenario. So, but yeah, it's interesting Ian's caution there in terms of value as we use on this. So although the government may be encouraging you through permitted development rights to convert office blocks into flats, yes, they're not aesthetically pleasing, and the valuer's worried about downstream value. And again, there may be some issues in terms of if it's mixed and you've got I don't know, shops on the ground floor, an office above it, and then you've got a residential one which is a conversion, you may find it's not quite as perfect a setup as it might have looked at like originally.
So that may not be the panacea in terms of solving our shuttered up high streets as the government might want.
Well, possibly not. So I see Ken's.
Exactly. If I set up my limited property company with all the correct codes specific to trading in property, so he's done the right thing, he's got all the right codes, Ian, and so on, would I be able to get a buy-to-let mortgage for my first property, and what criteria would be needed for the application process? Ian, how would you look at that from Landbay's point of view?
I put a little reply there. Yes, we'd accept that. You don't need any experience, so we don't need like a year accounts before we do lend to a limited company. We'd literally, the client can walk into an accountant today or do it themselves. We would lend to that limited company tomorrow as long as we have the company registration number. And you can have up to 4 SIC codes on a limited company. If you're doing property, I typically just go for the most common one, which is 68209. There are a few kind of iterations from that, as Angus said before, there's 3 that are very similar that most lenders will accept. But 68209 is typically the most common.
That's really
the only thing I would add to that, I mean, yes, you're right. In most lenders who do limited company would be willing to accept a limited company application from a new landlord, as long as it's probably not a HMO or a multi-unit block within it. But the issue then is, do you meet the other criteria that they may set? They may have minimum income requirements. They'll certainly have requirements in terms of interest cover and so on. And so what I would suggest, Ken, if you go onto the Property Master site, put in all your information as if you were mortgaging a new property. If you don't know the address yet of what you're doing, just put in I'll say a fake address, but just put an address in there, say what it is in terms of what you're trying to do. We like to have an address there, but if you say, well, I've got this flat and putting a limited company, this is my personal situation, whatever. This is the sort of location I'm looking to do it in. But try and include some of the other elements that we might require, which do make a difference. Is it ex-council house, for example, or ex-council owned? Is it inside or outside M25? What's the current value? How much? Don't go for more than 75%. There are very few players who would let you have. There are people out there who give more than 75, but the rates get very high, and you significantly limit your choice by going above 75 in terms of what's out there, and see what that says. And I'm guaranteed that we will have some good lenders there for you, as long as you meet their overall criteria. But let's understand what it is you're trying to do, and we can help you with that.
I mean, we do, obviously, we track rates across all lenders and all sectors. And, the last lot of data looked as if limited company lending was that the gap between the cost of limited company versus standard was narrowing. Angus, do you think that might actually be happening? Is it?
Well, I think it is happening, and as Ian was saying earlier, that there are the gaps between standard buy-to-let and some other elements are reducing as there's increased competition. I think if we go back 2 or 3 years, there were a lot less lenders playing both in limited company, HMO, multi-unit block. There's an awful lot more specialist lenders in the market now. They're recognizing that there is a niche here which they can make money on, but they're having to compete with each other. And that's why, for standard stuff, it works quite well. Where you're still getting some premium pricing is if it's a large HMO, large multi-unit block, where you've got many fewer lenders competing in there. As Ian said, they look at them as sort of semi-commercial. Well, Ken, don't go for one of those on day one. Keep it sensible. I think is my advice to you. Don't, again, walk before you run. Understand what you're doing. Get a decent property in the right location, and ensure there's demand there. Don't be overinflate the value you think it is in terms of what you're going to do, and you'll get a mortgage. I'm confident of that. Again, there are other situations. I mean, if somebody's got a whole pile of credit defaults behind their name, getting lenders to finance somebody who's got a string of CCJs isn't easy. I'm not saying it's impossible, but your own personal credit history plays into this when you're buying, even if you're buying to a limited company. So understand that there are other criteria lenders use to differentiate over and above purely the property.
Excellent. Hopefully that's helpful, Ken. I've put our email address there, or you can visit us on our site, or even use the calculator on our site. And as Angus says, you can just play around with that and see what's available. I think we've actually gone over time here. Thank you so much, everyone who's been on the line, and thank you, Ian. That was so interesting, useful. I mean, I've given us lots of ideas, and I hope you'll come back again in the future. It'd be lovely to have you back again, and thank you, Angus. We will send out a recording, as we always do, of today with our latest newsletter. And of course, next week the Bank of England will meet on Thursday, and I'm sure we'll be talking to you all again then, because it looks like the only way is
I don't think it's not next week, it's the week afterwards.
Oh, sorry, you're right, it's the week after, isn't it? Yeah, so I'm getting ahead of myself there. But yes, it looks like the only way is up. So we'll keep in touch with you all and give you the benefit of our insights as to what's going on. So thank you all so much for joining us, and I'll see you all again next time. Thank you. Thanks, Ian, as well. Thank you.
Yeah,
Bye,
thank you, Ian. Thanks, everybody. Bye now. See you soon. Cheers. Bye-bye.